transition into the thought of the day, the daily trading affirmation. Repetition is the hallmark of having a trading edge. Trading the same setups and managing those trades the exact same way, trade after trade. If you're doing something different every trade, profitability is likely going to become very elusive. Consistent profits require a consistent process. And so this is getting to know yourself, your edge, and the setups that you like to see and how you like to manage them. So I'm always looking for patterns, and then I'm always looking for the reactions out of the patterns where you get a setback and you have a trading channel, or you have some kind of flag that then suggests that there's going to be a breakout after we see the pattern. So I've kind of come to understand my personality. I've come to understand what patterns I'm looking for, what kind of setups I'm looking at, following the pattern. And this is something that you should get to know of yourself over time. If you're chasing something when it makes a new high, or similarly a new low, or you're kind of going with the fad of the day, or you're looking at the news, and the semis are running and something's going on and you find, well, I need to go there and I don't need to go there, you're departing from what is consistent for you. So I remember late last year, technology stocks were taking off. NVIDIA was going through the roof, and I was kind of beating myself up that I wasn't taking part of that, and I was instead looking at these small little bank stocks, Wells Fargo, Capital Group. And since then, those banks have doubled, and the risk reward on those trades was ridiculous. I could get in those trades for $1 and make $4. And so know what your edge is and apply that consistently over time. So that is kind of the message for the day. The three major U.S. stock indexes. We've got the Triple Q ETF, which is the NASDAQ, the SPY, which is the S&P 500, and the DIA, which is the Dow Jones Industrials. And we were watching this in a 3, 4, 5 month trend go in this channel. So I like watching channels very much. You notice that the markets then made another channel here and now appear to be perhaps making another channel here of a different type. Now what I also see here is this flag. So sometimes we get a move lower, the market flags, and then when you get a breakout, there's typically a continuation move. And that's what it looks like is on the horizon, that we run into a resistance level. This looks like a bull flag, and we'll have to see how it breaks out. Just a little word of caution. Yesterday we had a big range day, and today we're gapping lower. We're just opening a hair lower. So, I always look at to see how the energy comes into the day. And to me, I would have much preferred if this thing had gapped higher. I would feel a lot safer shorting that because the energy looks lower than now trying to get on a FOMO trade where it opens lower, you think this market's going lower, and anything can happen. So now that we've opened lower, to me, it actually raises the possibility that we could rally later in the day, and anything is going to be possible today. So if you're not sure, if you really can't see your risk, or your risk is pretty far away, sit it out, let it settle out, and don't feel compelled to chase things. S&P, same kind of look. We had a high tight directional channel for many months. Then we got into a kind of rectangle top, if you will. And now we've begun what looks like a move to the downside. And here we have this channel, and we just leaked through the bottom end of this bear flag, if you will. So, you know, the flag against the trend, it's called a bear flag. And it does feel like there's still going to be a break to the downside. Dow Jones actually started flashing a bear pattern, a clear one, a few weeks ago. Here was a very distinctive, where you can see that, you know, the NASDAQ was very muddled. So this was more of a rectangle top, where basically prices just hovered within the boundaries and then broke lower, and that's a rectangle top. In contrast, this is a double top price pattern. Just what it sounds like. Market makes a peak. Market makes a peak, backs off from the peak, retests the peak, and now we have a clear looking double top. And just to add injury to insult, we also have the head and shoulders. And we broke through this neckline. You can see that we came back, retested the neckline, and now we have what looks like another double top at the retest, setting into motion 375. We're at 378 on the DIA ETF, and it looks like the first test is going to be about 300 points lower. Having said that, you know, we are in this, just try and find a contrast here. We've got a bit of support in and around here. So we could break this and then react to the upside, and it's very possible that, you know, we could have, you know, some sharp jagged edges in this range-bound affair. But it does feel that this has made a top, and any big rally. So to my mind, if something comes out, the Fed says something, the market kind of likes it today, market rallies 300-400 points, I would likely be shorting into that. You can see that there's a bit of a reversal right here, so you could be walking into a trap by shorting this, and then you get some kind of short covering rally. So, you know, there's a lot of possibilities today. The risk is going to be very high because you're going to get a lot of moves and a lot of counter moves. And again, just keep an eye on the big picture, but it does feel like we're starting to leak to the downside, and that we need to, you know, test some downside things. But, you know, anything's possible. You could get a fake out, a shakeout, and something all the way back. So anything is possible in these kind of environments. Now, again, I don't really encourage intraday trading. I kind of have a little thing that I like to have fun with. I take small positions, and the way I play Fed days is that the announcement comes out at 2 p.m., the interest rate statement. And then we watch what the market's going to do. So from 2 p.m. to 2:30, the market is going to go in one direction. And obviously you do the other. So I watch what the market does from 2 p.m. to 2:30. Then the conference starts. And typically you start getting a reaction the other way. But to me, whatever the first reaction is how the day is likely going to end. So if you get this first reaction that goes lower, 2:30, somehow you said something, market starts rallying, then 3 to 4, you're likely to see it go back in the direction that it started. And it's kind of the reverse, where if the market starts higher from 2 to 2:30, from 2:30 to 3, we go lower, then we're likely to start going back higher in the last hour. So you always kind of get this one head fake in between. Now, you know, you can't set your watch by it, but, you know, it happens often enough. So I kind of watch these things and, take some small positions just for fun. Like I said, it is all over the place. The volatility is ridiculous. And, your best just, again, be consistent. Understand, what you want to trade. Understand your setups. I always, like waiting for the market to, give me a better risk reward trade. So instead of shorting, so today, we're just going to open lower. Dow Jones opened here. Now we're going to open here. This is not kind of where I feel comfortable, just chasing something right into a support area. I rather wait for some kind of reaction. If it doesn't happen, then, I'll wait another day for another trade that does give me what I'm looking for. So again, it goes back to consistency. Find out what you like. Find out what offers you the best risk-reward opportunity. And don't be just chasing FOMO all over the place.